for joining me. In just a couple of minutes, I'm going to explain that many Americans don't know that Uncle Sam has an extra tax on investment income for high earners, at least until they owe it. Now, millions more taxpayers are owing it thanks to inflation and higher bank account and bond yields. This is also known as the "you make a lot of money" tax. This levy is called the investment income tax, or NIIT for short. It's a 3.8 surtax on a filer's income from sources like interest, dividends, and capital gains that applies if adjusted gross income, or AGI, is above $200,000 for most single filers or $250,000 for most married couples. It affects one-time spikes as well as reoccurring income, so taxpayers who typically earn less can owe it in a windfall. Although the 3.8 rate tax is low, the NIIT deserves a closer look because even small taxes can affect investment decisions, such as whether to choose a tax-free municipal bond over taxable bonds, or maybe to do an IRA Roth conversion. Now, when the lawmakers enacted this tax to help fund Obamacare expansion, they chose not to adjust the 200,000, 250,000 thresholds for inflation in order to collect more tax. And as a result, this NIIT revenue has more than tripled since the tax took effect in 2013. It rose from 16 billion to more than 60 billion in 2021. Now, over that period of time, the number of taxpayers owing it more than doubled from about 3 million to over 7 million. Now, with planning, some taxpayers can avoid the 3.8% surtax, while others may only be able to reduce it. And here's more to know if you're grappling with this surtax. The 3.8 surtax applies to net capital gains on asset sales, including cryptocurrency, dividends, interest, including on CDs and bank accounts, and royalties, among other things. It also applies to net gains on the sale of a home above the exemption of $250,000 for single filers and $500,000 for joint filers. Rental income can be subject to this tax as well, unless it's from an actively managed real estate business. But there's income that doesn't apply. Wages, pensions, Social Security payments, and taxable retirement plan payouts aren't themselves subject to NIIT, but they can help trigger it. Tax-free municipal bond income is exempt as well. And income from a managed business such as a partnership or S-Corp doesn't apply either. But this may change as the Biden administration wants to make income subject to NIIT. The 3.8% surtax is a levy on the taxpayer's net investment income that raises the filer's marginal rate on it. Now, because investment income stacks on top of the filer's other income, wages, IRA withdrawals, and other taxable income can help push the investment income over that NIIT threshold. Now, there's several strategies to consider to help lower your AGI, which can reduce the surtax. Even older taxpayers taking IRA payouts have several strategies available to reduce AGI and to reduce and avoid the surtax. So ask your CPA or financial advisor if you're going to be subject to this surtax. And if you are, find out what you can do to reduce or avoid it. If your financial advisor doesn't know, give me a call. We'll help you find the information you need. So thank you for watching this video.